Good evening, guys. I hope you have had a wonderful Wednesday, wherever you might be joining us from. My name is Jesse. I'll be covering what has been happening, particularly to the Kenya shilling in the last couple of weeks or even years, and of course, how it can affect, be it your pocket financially in terms of expenditure or earnings, and obviously what the future looks like in the coming days, particularly given the significant appreciation of the US dollar against the Kenya shilling. I'll be your host, Jesse. I'd encourage you to share, of course, this session with your friends who might be interested in understanding what has been happening, what has caused the significant appreciation in price over time, and more importantly, obviously, is it a cause to worry or not? As we begin, I hope you can see my chat, so I'd recommend you to be quite open with your question, comment, at least on the chat box, so that I'm able to address your particular concerns, particularly affecting the topic for the day. So as you can see, it is a chart of Kenya shilling, particularly against the dollar, the exchange rate over the last 5 years. And you notice that we have had, I'll go back a little bit longer, over the last 10 years, since 2013, there was a significant rise between 2013 and 2015. Until 2015, there was a mooted price appreciation or depreciation for a period of, say, 5 years. And some allude to maybe market monetary control or hard control by the central bank, so that the Kenya shilling was trading against the dollar between 99 shillings to a dollar to 105 for a period of 5 years. While I will show you later, the dollar during that period had an extended, let's say, a very volatile price movements, as attached in a chart I'll be showing you later. And that is significant because for a currency pair to be healthy and therefore trusted by the market, it needs to be, say, strength and weakness determined by the demand and supply forces, which is not the case, given that it was more or less on a linear curve. And it was exacerbated late 2021 when COVID effects were starting to at least rife. And you notice there was a sharp increase in price between around June 2021 to all the way to 134 shillings to a dollar over the last 3-4 weeks. So it has been hovering between 130, and if you go to other financial institutions, you are getting a price of even 140 buying and selling. Yeah, so I like to go to another chart. Okay, I hope you can hear me. Now, over the last couple of years, since this chart is derived from Mwango Capital, it shows us the total debt in Kenya, particularly those both domestic and external. And you can see it has been steadily rising due to government heavy borrowing to finance its infrastructure projects. And therefore, when the government borrows significantly, this is either to pay salaries of civil servants or to construct major projects like SGR, like the Nairobi Expressway. It has played a significant role in putting heavy burden on Kenyan taxpayers to refinance this debt, maybe to external investors to Kenya. And when the debt grows to a degree that it becomes unsustainable, and if you have been following the news over the last couple of weeks, you notice that not only parliamentarians who can qualify as public servants are having delays in their salary, and previous administration would go into the markets just to get short-term financing, either by T-bills or even T-bonds. And the T-bills basically is the government seeking short-term loans, typically not exceeding 1 year. It usually offers very good return, maybe 14%, just to finance maybe salaries or even recurrent expenditure, which includes, of course, wages and other maybe payments to suppliers to the government. And a report which I think I'll be able to share the link shortly, shows that the appetite from local investors, be it banks, be it individual investors, is showing very low subscription rates to the short-term financing to the government. You are seeing even the 3 months or even 6 months T-bills having very low subscription, below 25%, which is a cause to worry, given that the investors basically do not believe in the ability of the government to sort of pay back these loans, given that we have Eurobond, which is also maturing next year, and we will have to pay this. Of course, this is coupled up with some of the news you have been seeing, whereby government is looking to get oil, which is our main import in terms of quantity, and obviously the main consumer of the Kenya shilling paid out in return to get the dollars to pay the oil. So if the investors do not believe in the ability of the government, in the ability of the economy to grow, in the ability of local economy to sustain repayments of debt over the next couple of years, it's a cause to worry. And that is why you are seeing a lot of investors maybe opting not to invest or lend government in the short run. Going to a very interesting chart here, you will see quite there. You are seeing the composition of the Kenya domestic debt. There is a high a degree of number of people are actively purchasing or holding their bonds, and this is definitely mostly held by banks, the local banks, whereby you have your deposit, and in order for them to say get some more returns or even liquidity to finance loans to individual lenders, we are having local banks and individual investors lending to government in the long run, that is 10 years, 30 years and more, and then the short term in that regard. Another piece of data that is playing a role in the strength of the dollar to KES is the exchange rate with which you can buy a dollar in the market. So the CBK has a different rate, and I will show you shortly after this. At the moment today, as of today, it was ranging around 134 shillings to a dollar, which is not the same as what we are seeing in the market, which is almost 139, 138, they are about. And on earlier in the week, towards the end of last week, when the IPRA, which is basically the main regulator within the oil market in Kenya, they have a different rate in which they use to determine if the price of oil or even petrol in Kenya or even diesel will appreciate or depreciate. And you can see there is a very big spread between the CBK rate of 134 and over 137 shillings to a dollar, for which EPRA is using, which is basically a reflection of where the current exchange rate is standing. To another slide, which is more important before now we get into the charts, is the remittance from diaspora, either Kenyans working, studying, living, or even including investors sending dollars to Kenya for various investments. This plays a big role in stabilizing the USDKES exchange rate, given that it allows the CBK to have a significant reserve that can allow for at least 4 months of import cover so that they can use to mainly purchase crude oil, which is one of the largest players to how the cost of living will be in Kenya. So with this information, I'll be able to share it shortly. And of course, when the webinar goes out live, where you can check it out and reference, plays a significant role in stabilizing the price of Kenya shillings to the dollar for those who participate either in the import business or even in the local manufacturing or even just trading or as a store of wealth to their investments. Now, to the international markets. As I continue, kindly make sure that you let me know if you are able to hear me clearly. Ask away your questions, at least in the comment section. I'll be glad to go over it with you. Yes. Are you able to see the chart on USD that I'm sharing, the dollar index? You can reply in the comment chat section so that I'm able to understand that we are together. Excellent. Number one, dollar index. It basically is a basket of currencies compared to the dollar, the major pairs, of course. It is used to determine, or investors use it to track how strong the dollar is going vis-a-vis other currencies like the euro, the Japanese yen, or even the Australian dollar and the Canadian dollar. You can see over the last couple of years, including today, it has been steadily rising, especially during the last year, 2022, between, this would be December 2022, all the way to around December 2021, all the way to September 2022, where it hit the highest, that is 114 price level. And then this is also coupled up with a significant height or appreciation in the cost of living, which is reflected by the CPI or the Consumer Price Index. And when we had almost around 8% on a month on month, and obviously year on year, a little bit lower than that. It tells you how strong the dollar is going. And this was as a result of a lot of printing of USD, in other words, quantitative easing, whereby the central bank decides to lower the interest rate. By lowering the interest rate, the commercial banks are able to lend to the public at a very low rate, and therefore local consumers are able to spend it on various activities. It can be either personal consumption, maybe they are buying a new house, maybe they are expanding their business by hiring more staff, maybe they are increasing their production by purchasing more supplies. So when there is a lot of money supply in the market, basically all of us have money. Obviously the sellers in the market will try to sort of benefit from that, and therefore raising the price of it. So when inflation gets too high, it's because there is a lot of money supply in the economy, and therefore it becomes unsustainable. Not that inflation is bad, but a moderate and predictable inflation, that is what is the economy at least appreciate, because not only does it affect how much you spend in the market, but obviously it affects also how much you earn in terms of maybe your wages or your investment. So we experienced a significant appreciation on the dollar towards the start of 2022. And if you look at the second chart, I hope you can be able to see it. I don't know if it is clear. I'd appreciate if you're able to comment on the section. Let me try and, yeah, I've opened up the comment section. You can comment there and add your question thereabout so that we are able to move together. You will notice on the chart I'm showing you, it shows the balance sheet of the Fed. Balance sheet is basically the total number of assets and liabilities the Federal Reserve, which is the equivalent of Central Bank of Kenya, holds. And you notice when the COVID-19 hit around late 2019, early 2020, until such a time when US basically entered into some degree of economic shutdown, there was a sharp spike in terms of how much the US Federal Reserve held in asset. That was from around $4 trillion to around 6.87 thereabout $trillion in asset. What does this mean? US basically went into a money printing venture whereby they would allow those who have filed for unemployment claims to get around $2,500 bi-weekly, and therefore they're able to maybe spend on food, they're able to maybe pay their rents on time, they're able to, if they're playing or even invested within the financial markets or capital markets, they're able to buy a couple of shares, and which was quite significant or visible through the GameStop stock, which actually appreciated during that time by over 300%. And you see, this definitely increased the amount of dollar in the market, which is typically a very a good sign, because it allows for the economy to go on, meaning people are spending, the suppliers and producers and the retailers are earning something, and it keeps the economy in circle. If there is no spending in the economy, means that the government will not collect taxes, of course. It means that retailers will not be able to pay wages of their staff. Retailers will not be able to restock their stores. So that definitely played a significant role in that regard. Another period where we experienced a very steady rise in Fed balance sheet is throughout 2022. This was when now we started to see COVID sort of declining in terms of its impact, and some economies opening up. And that is when you notice that they stopped or sort of paused on the quantitative easing measures, and they started now trying to see how the economy reacts to all those measures put in place to address the cost of living, and obviously jobs which have been lost in the markets. Raymond, I've seen your question, and I'll be able to address it at least in the coming minutes. So be sure I will cover it significantly. Yeah, so that is the balance sheet of the Fed. Now, remember one thing, and I think this is quite important that I mention. The strength and weakness of the dollar is primarily dependent on the political decision, and obviously policy decision made by the US, and less what we as Kenyans or even our economy in terms of political or even monetary policy decision do say. So as an investor, the strength of the dollar you will have to wait, or rather monitor what the Fed do, what the Fed is the Federal Reserve Chair, what they do and state, what the President of the United States, that is Biden, do, and therefore you are able to see how the markets react to it. So that is the strength of the dollar. To the Kenyan shilling, of course, that is dependent on what the Kenyan economy does in terms of, you have noticed, or even to digress a little bit, where the President and of course those involved within the economic stabilization have been doing, trying to maybe forward the payment of petrol in terms of crude that we import, to delay the payments on time to at least 6 month basis, so that they're able to accrue a significant amount of US dollars, so that when they pay it, we still also have some degree, some reserves to pay for the Euro bond, which is maturing next year. So it is some way addressing the dollar demand in the current economy or market, so that we do not have basically a hard stop when we default on our loan. So these are some of the policy measures put in place to address such. Now, to what degree did the Fed balance sheet and of course appreciate over time compared to previous times in the economy? This chart should be very interesting. Let me share it with you. Continue to add the question. I'll be glad to cover them as we proceed. This is a chart of Fed balance sheet since 2002 all the way to 2022, at least, and year to date. You notice during the two significant periods I'd like to mention, 2008, when we had the financial crisis, the Fed balance sheet grew by almost 1.3 trillion over that time, meaning that there was a lot of printing. When I say printing, by the I mean that the Federal Reserve basically sort of buys all the securities. Remember earlier I mentioned that the banks, the local banks, they do purchase the long-term bonds or the treasury bonds, and these bonds are basically let's say letters of credit, or in a way paper value. So the banks hold it owing to the fact that they'll be receiving interest payments on their coupons on a 6-month basis. So that way, if you deposit in a bank and this bank will say use your deposit to purchase bonds or other securities as a way of adding value to your savings, that way they're able to sort of use that interest to maybe finance other activities or investors. Now, when there is a financial or liquidity crisis, that means that the assets are there. It is just that there is no significant yield compared to the demand of money from the economy. So maybe people are starting to demand a lot of withdrawals, and if the banks cannot liquidate these long-term assets quick enough to satisfy depositors' interest, that causes sort of a liquidity crunch, and that is what happened to the Lehman Brothers Bank in the 2008 financial crisis, and obviously tied up to what happened in the last 2 months, whereby SVB, Silicon Valley Bank, Credit Suisse Bank, and the First Republic Bank, and other 3 banks therein suffered because they do have assets that are long-term. They are just not liquid enough to satisfy what investors or depositors would wish. Couple up with bank run. Basically, bank run is when everyone lines up in the bank and wants to withdraw all their money to maybe they just want their money. So if the banks cannot liquidate their long-term holdings fast enough to satisfy that, it causes some significant crisis and crash basically of that bank. So in 2008, we had a significant 151% rise in the balance sheet. So when the Fed basically prints out money, so they print equivalent of what the bank holds, and that is known as BTTF, which is basically a way in which the Federal Reserve offer a credit line, a quick credit line to facilitate cash withdrawals. So when you deposit money in Kenya, there is an insurance, Kenya Deposit Insurance Corporation, KDIC, which covers all your deposits up to 500,000 Kenya shillings. In US, it is known as FDIC, Federal Deposit Insurance Corporation, which covers, of course, your deposit up to 200,000, I think, dollars with a bank. So this is different from what the Fed does. When they open, let's say, a credit line, it means that this bank can facilitate withdrawals. They can facilitate payments of maybe short-term, let's say, obligations, and that allows for cash to be circulated in the economy so that there is no basically a bank crash. And you compare 2008 to 2020. Now, economics and scale are different. In 2008, it was 1.3 trillion. In 2020, it was 3.1 trillion, which is equivalent to around 76.7% just within that year. But you'll notice throughout that period, since 2009, after the crisis was sort of alleviated in 2009, there was still a significant printout of money, whereby around 2011, a significant 20%, 2013, significant around 38%. Now, during this period, we had a significant period of low interest rate. So even though the Fed were not necessarily printing, you could get loans from the bank, be it mortgage, be it personal loan, at a lower rate. So when there is such situation in the economy, it allows for everybody to also have a lot of money. So people are investing maybe in long-term bonds, and that allows for governments to maybe maintain their rates at a sort of advantageous position to them to get loan from the public at a lower rate. Now, to another asset, this is comparison between, and I think this covers what Raymond has asked, what is the current de-dollarization currently take place in the BRICS. Now, this chart, I hope you can see it, so you can confirm to me on the chat section, kindly. If you're seeing it, just say yes or a thumb sign so that I'm able to know we are together. It shows the total assets still within the balance sheet narrative or a theory, whereby Federal Reserve compared to ECB, compared to BOJ, compared to People's Bank of China. You see, one thing is quite familiar. Throughout 2020, all of them had a significant rise, albeit, of course, the Bank of Japan being the highest in terms of holders, in terms of total liability or balance sheet compared to their gross domestic product. This is obvious because if you look at one of the list of countries, institutions, investors, banks, and other financial institutions holding US debt, Bank of Japan, and of course, Asian investors are significant participant in that market. So it goes without saying why they are way significantly above the others. And you will notice even in terms of their interest rate, Japan holds a significantly low interest rate, meaning that that is how they sort of manage their high balance or extended balance sheet compared to their peers, at least within the G7 economy. To another piece of data which I think is significant. I hope you can see that chart. That is the excellent, where you can get the data on current exchange rate. Now, the CBK sets its rate, of course, dependent on the reserve they hold, while the market sets its rate based on the demand and supply of the dollar. And you'll notice, given that the largest consumers of dollar would be maybe oil, given its significant input to our economic growth. Now, all these factors play a role. Whenever Kenya shilling is weakening, it means that the economy needs to work harder, or the ordinary people need to work harder, generate either more taxes or generate more products that will be selling at a good price in the global economy, so that we're able to earn foreign currency. Now, if the economy is not producing in a way that is matching how much we are consuming, that is importing from the global markets, it affects the strength of the currency, because it means that if the chart I showed earlier, whereby within a year, the Kenya shilling has risen from around 115, 120 thereabout to almost 135 within that period, it means that we were importing more, and therefore we are spending more money to service a debt than the economy produces, which becomes unsustainable, based not only on the local debt we are liable to, but also the maturing European debt, which are predominantly set in USD. So it means if the dollar is too strong for us, we'll have to spend more, not only to pay the interest, but now we will need to find a way to either significantly raise taxes, which you have seen, or remove some of the subsidies, which we have seen from maize, we have seen on fertilizer, we have seen on and of course, at least trying to tame that is foreign lending, just to pay recurrent expenditure. So some of these policy directives done by the current government to sort of not increase the balance sheet to from where it is at the moment is one of ways to ensure that we have at least to be on the safer side, maybe more than 5 months of import cover. That is a foreign currency reserve, which would be a good thing in the market in general. Now, how does that play out to you as a trader trying to sort of engage the markets? Let me just share a chart here. Hope I can be able to. Excellent. you can see, I picked this chart because it is significant. Now, on the yellow marked area, the VIX roll or the Volatility Index, available on the portal, it tells you how markets are volatile. And the yellow part is when we had the Silicon Valley financial issues. They could not pay their depositors on time. Their stock was basically tanking, and there was fear of a contagion. A contagion basically is if one bank is ailing, they cannot service their customers or honor their customers' request for funds. And that is caused primarily by these banks holding the long-term bonds, meaning that until their maturity is way past, let's say, in the future, and for them to liquidate it, they'll need to get a haircut, and this would be a significant haircut. They would have to liquidate their position at a basically discount to other, let's say, hedge funds or other banks. So when Silicon Valley faced such a scenario, the people or investors would want to now look at other banks, at least within the economy, if they still have such a huge unrealized losses. It isn't a loss until they're closed, but if the losses are too huge that they'll have to either get financing from other institutions. That means that there is some significant breaking situation that needs addressed there. And why is this the case? I mentioned earlier that the strength and weakness of the dollar is dependent on the political and fiscal policy decision of the respective states. And this is the United States by the Fed and obviously the Biden administration. The Fed has significantly increased its interest rate, but over the last 1 year, from 0 to 0.25% to 5% at the moment. So if that is the case over the last 1 year, that means that the interest rate implications would not be felt instantly, they will be felt over time. So 1 year on, we are starting to see, okay, now the cracks are starting to happen, because what a high interest rate means, the short-term bonds tend to sort of give you a good return over a period of time, while the long-term bonds do not look as attractive, because what the Silicon Valley Bank held was at, let's say, 1.25% yield on an annual basis, while the long-term bond is giving you almost 5%. So those are some of the factors. This is the chart I'd like to share on the interest rate hike over the last couple of years. If you can be able to see that chart, since April 2022, they have done almost 4.75% increment, which is actually the fastest ever done. And I'll just go back for context purposes. 10-year period. Let me go 25. You'll notice it's even during the 2008 financial crisis, it was not such big. I mean, they rose it to around 6% during that time. And at the time before they started the increment, it was around, this would be around 1.25%. So you see, compared to where we did, it is basically like a vertical appreciation in price over 12 months. And when you stretch or cut down supply of money so sharply that you do not allow the market maybe to digest the news, maybe readjust their books, it causes shocks in the market, which we are seeing at the moment. And that is why probably the Silicon Valley scenario started causing some degree of fear in the market, and that significantly increased volatility at the time. Just let me load the chat. Feel free to add your question. I'll be diving into Q&A at least in the last around 8:40, 45 thereabout, so that we're able to address the chart analysis and obviously your opinion and address your concern. So we saw volatility. When such volatility rose, is because of two things. People were either aggressively dumping their positions on a particular asset class, and this would be, of course, in the banking, because you see the price definitely depreciated by almost 30% within a trading day. So that was one. Another asset class which experienced some sort of appreciation when there is fear in the market. Definitely one of the asset classes people typically run to is gold, due to its a historical affiliation to store of value and the wealth of period of time. And you notice around March thereabout, this would be around March 15th, there was a sharp increment in the price of gold from around $1,800 an ounce to all the way to 1900, and it continued sustainably all the way to 2000, and I think the highest it reached was around 2048 thereabout, before recently correcting itself and hovering between $2,000 to around 1980s thereabout. So analysts, investors, and obviously all those participating in the sort of correction and stabilization within the financial sector, saying that it is not over. There are still some data points to look at so that we can conclude there is no more risk of contagion. Why I say so is because it did the gold appreciation rather, was exacerbated by the Credit Suisse collapse, which also held significant unrealized losses in long-term bonds, and that affected, of course, the financial sector. Now, why do I go to these financial issues and then come back to the USDKES crisis? It's because any issue that is affecting holders of US debt, significant US debt, definitely plays a role in the demand and supply of the dollar. And that is why if at least people fear that the banks will collapse, and that means that sometimes there will be default on debt payments, people will now start to not hold the dollar itself and look for other alternatives. And that leads us to the dollar itself, the dollar index. You notice since March, the dollar index has been depreciating due to that fear, because they are not confident that the situation within the US or even the banking scenario is sort of stabilized. So all these couple up together, the spike, as sharp increment in interest rate plays a role. Another significant issue is the bank run. So bank run is sort of people, especially the large holders of savings or deposits in banks, start fleeing. That plays a role. And then we go to supply chain issues now. If you have been following the price of oil recently, you'll notice that there was a statement made by OPEC plus countries, that they will cut production by almost 1.16 million barrels starting next month. That plays a significant part because dollar is primarily traded in oil is primarily traded in dollars. So if you remove that, you significantly weaken, of course, the demand of dollar itself. And to answer your question, Raymond, I think like the chart earlier I showed, whereby a lot of banks, especially the central banks, hold US assets, that is the treasury bills over 30 years and 10 years and other form of US debt. So long as they hold such a significant amount, it would be impossible to just decide one-off that you will dump the dollar for another currency or another mode of a global payment system. So that is why even though the BRICS are significantly choosing to for alternative or looking for alternatives to the dollar, they raise a potent question. That is, if the US, which is sort of the dollar itself, plays a role in the sense that they can weaponize it, whereby they can put sanctions to economies these countries would not like that. And you see, one of the largest producers of course, of oil is Russia, and one of the largest consumers generally in the global scenario is China. If they decide to couple up together, that will allow them maybe to trade, and obviously Russia will find a way to maybe improve the economy, while China will find maybe optimum price for the oil to sustain their manufacturing. So it is cracks or signs, but it is far from actually being realized just within a one-off. I think the most danger is that at the moment there is a lot of echo chambering, whereby people maybe are talking to each other about the same thing. So it looks like it is a big issue, but it is something to look at the moment and monitor and see how it plays out in the general market. One of the aspects that maybe can indicate that maybe there is a move away from the dollar is the significant holding of US debt. Maybe that can be a good role in the coming years. Maybe if these economies reduce their consumption of US debt to finance US development, or even finance US maybe world peace initiatives that incurs a lot of dollars. So when there is a decline in that aspect, then we can say, okay, there is a significant de-dollarization, but at the moment it is just, say, symptoms of or intent of adopting other means. This would be a good time for those who are interested in addressing a question to share their concern, as I will sort of wind it up, at least in terms of analysis of USDKES in crisis. Bottom line, until such a point whereby I think recently we saw in Kenya they are delaying payment of oil imports, at least for a significant period of time, 6 months. They intend to increase it to 12 months. What that means is that we will have time, or the economy will have time to collect more revenue. They'll have time to pay their debts and reorganize or restructure how they're financing, and obviously priority on which dollar liability or obligation goes first. And we are fast approaching the payment of Eurobond, which is maturing next year. So their action or their policy decision is to allow the economy to sustainably pay off this debt in a way that doesn't cause shock to the economy. That is number one. Number two, it is advantageous to you if the dollar is weakening, and this is visible by how the index has been behaving since the start of March. If the dollar is weakening in the global markets and eventually trickle down to Kenyan economy, whereby maybe you are paying, instead of 139 shillings per dollar, you are paying 125 or even 110 or even $100, 100 shillings, sorry, per dollar. That is a good thing, because it means that your cost of living will go down. It means that if you are an international trader, you are traveling abroad, you will need less of your hard-earned shillings to get equivalent of a dollar, especially given that other economies, predominantly, let's say in US, using in dollar, you might have different spending capacity. But in general, if the dollar is weakening against the shilling, it is always good, because it means you are spending less and therefore doesn't eat into probably the same amount of income you have been earning over that period of time for your investments. For traders, it's a good thing because it causes volatility in the market. When you are depositing maybe to your account, of course, those who trade with FX do deposit in Kenya shilling, and then it is converted for you in USD, so that you are trading in it on the various assets you indulge in. It means that maybe you will spend less in the market in the exchange period. Some time back, I think 5-10 years ago, the dollar was around 90 shillings per dollar. It came back to hovering around 100 shillings per dollar. And at that time, that is why I think most of the investors are stuck at that phase of $100 is 10,000 shillings. So that allows for, when the dollar is predictable, that exchange rate is predictable, it allows for economy to plan itself, and obviously as an investor to plan yourself well. Now, another thing, if the dollar is weakening, meaning that there will be volatility in the market, and as we can see, the VIX roll has been basically declining, at least in this month of April. Volatility has been quite low. I think we are at an all-time low of 17%, 17.13. Why is this significant? It means that you, for long-term traders or position traders, they're able to put their analysis in order in a way that they allows them to hold for a significant period of time until maybe they see a pivot coming about. So it allows for maybe calm in terms of how you organize your investments or your portfolio. Another advantage, maybe as I wrap it up, is that cost of living, which basically affects your pocket. If the dollar basically weakens against the Kenya shilling, that means that maybe the amount you spend per liter of fuel, if it is 179 for petrol, if it is 160 maybe for diesel, it will go down. So it means if you are spending maybe 20,000 to fill your tank on a monthly basis, maybe you'll spend less, around 15,000. So that is a good, so that you can spend maybe the extra amount you are not to spend maybe on other investments. So it is overall a good thing. Now, back to the topic of the day, is it in crisis? Yes, it is showing signs, but as we all would like to do, obviously, is align with the current situation, try to see how it pans out. Of course, next month we'll be looking at the Federal Open Market Committee when they meet to decide if they'll start reducing interest rate or keep it at it. So as investors, traders, that will be the critical data piece to determine how the dollar will be throughout the year, because if they start reducing interest rate, that means that at least the economy will cool down, given that inflation has basically come down over the last 4 months of the year. So that is a good thing. So I hope at least as you continue to trade, as you continue to engage the markets, this should add some context to the long-term view of the markets, and obviously alleviate maybe some fears or some confusion that have been, at least regarding the dollar. Unless there is a question, I'd like to give 5 more minutes to those who are left in the session. Maybe you have some question you'd like me to answer, kindly do so before we wrap it up. I think that would be good for your own clarity as well. If there is none at the moment, I'll go ahead and just overlay the Kenya shilling exchange rate against the dollar versus the dollar index itself, so that you, for those who joined earlier, you're able to see what I mean by when the Kenya shilling was basically trading at sort of control or strictly regulated exchange rate. Just a second to put it shortly. Yeah, so there it is. What I was referring to earlier, whereby between 2015 all the way to 2020, the dollar was quite aggressive. That is the demarcated by the orange, while the Kenya shilling was basically trading at a stagnant price range. So recently you have had the International Monetary Fund at least trying to encourage the government to let the markets be determined by the market. That allows for the players in the industry to actually trade and engage the markets at a realistic exchange rate. So some of these concerns are what we will be looking at in the coming days. And for those who want to understand, of course, where you can say, because we covered earlier the dominance or the significance of the dollar in terms of global trade, you can check under the YouTube page of FX Pesa. There is a podcast there known as Bullish Banter, covers that significantly. Or if you enjoy listening to your podcast on Apple or even Spotify, you can get that as well. We covered significantly on the dollar status, at least within the global trade scenario. And this was primarily between the US, of course, exchange rate and how it affects our pockets and the investment. Now, to Matthew Kiswili and Kevin Nyalual, yes, the recording will be shared later on on YouTube, so I'll be able to do that. And once it is going out, Matthew as well, I'll be able to share the presentation with you, hopefully inclusive of all the links necessary so that you're able to review it on your own time. Of course, should you want to engage myself or even follow-up questions, you can at least reach me either on the relevant communication channels, that is by email, which I'll be able to be added when the live recording goes out. And yeah, I hope that covers significantly the scenario of the Kenya shilling to the dollar. Other than that, have yourself a wonderful evening. Lawrence, not really. This is because there is very low liquidity to the KES USD, very low liquidity. So even though you might trade it, of which is quite impossible, prices might not necessarily move. Now, you notice from the chart I'm showing you is almost 10 years. And the only time it appreciated over time is between 2022 to date. What does that mean? If you held, how do I put this in a way that makes sense, at least for traders? Traders basically speculate in a day, and they're able to get something given that there is price appreciation over time. But for USD, maybe if you converted your holdings or your bank deposit from Kenya shilling to USD and put it maybe in a locked savings and held it since 2019 thereabout, then of course the value when you try to get it back into Kenya shilling would have been appreciated by a significant portion. But on a year-to-date scenario, or even on a day-to-day, the Kenya shilling exchange rate to the dollar is quite low in terms of volume traded, and therefore trading it would not really be possible. I hope that at least answers that. It has been a pleasure to those who joined. I hope you have learned one or two. Other than that, have yourself a wonderful evening. Let's keep monitoring this, and obviously be safe. Happy trading, happy investing.